So you're right. So far, we've not heard of any company, Netflix, Paramount, Warner Bros. Discovery, Disney, who says because they've raised pricing, it's negatively impacted their churn and retention. No, the reason Roku sold so well was because it was so easy to set up that my mom could do it.
Hi, everyone. For this episode of A Guy with a Scarf, I've had a great guest from the States, Dan Rayburn, streaming media analyst, someone very rigorous about statistics, number, financials.
That's right.
So someone that is not easy to convince. Hi, Dan.
Hi, thanks for having me, Carlo.
So maybe a bit about you for the few people in my audience that don't know you.
Sure. So real quick, high-level background. I've been very fortunate and privileged to have been in the stream media space the last 28 years, starting one of the first streaming production companies back in the days. I'm old, right? So I've been around 95, 96 time, doing live events, production in the field, audio only at the time, dial-up, raised some money, started a company that got bought, then went to a small ISP in New York City at the time called Bell Technology. They became Globix, raised $600 million a bond offering, did an IPO. So I lived that whole .com lifestyle, which was pretty interesting just to see what was going on in the market at the time. But today what I do is I do a lot of work on TV, CNBC, TD, Ameritrade Network, NPR, Bloomberg TV. So I spend a lot of time as an analyst on TV, giving out information. I do a lot of work on my blog for almost 20 years now at streammediablog.com. As a conference chairman for the Streaming Summit at the NAB show in Vegas, I produce that every April. I have my own podcast. I do some consulting, not too much though. But if I had to wrap it all up, my job is one thing and one thing only, as I see it, and that is to inform, educate, and empower others. And sometimes that's content owners, sports leagues. I spend a lot of time talking to vendors. I've been asked to testify by Congress and Senate. So I'm really just a collection point for information. And Carlo, a lot of people say, well, Dan's the smartest guy in the industry. And I say to them all the time, no, I am not. I get to talk to the smartest people every single day who are doing this stuff, who give me information, and then I'm a source of that information.
That's exactly how I see it, to be honest. For example, one of the first things I want to talk to you about is I was following, as you follow the Q3 earnings, mostly if you want in streaming and media. And it was fascinating. I told you it's a service to the industry in the end. It's like what I'm also trying to do is explore and share my exploration process with others in the end. So, and I understand that for you from CNBC to A Guy with a Scarf, it's a bit of a gap, but thank you for doing this.
No, this is great. It's casual, right? I'm hanging out. I'm not in the studio. I like it. I don't usually get this, so I like it.
I'm in Rome outside of an hotel, so imagine how random and casual this is. So my reading, which I'm sure it's not correct, is Q3 earnings, some positive, if you're on in that side, some positive surprises, some people beating estimates in terms of subscriber numbers. So my very simple reading is SVOD is not completely dying, like some people were saying. On the other end, advertisement in general may have some ups and downs in certain areas, but in general, it was not a bad Q3 earnings overall. But what is your summary? If you you see?
So there's a couple of things, for you and I that are in this industry, and we're playing the long game here. Right? We're playing chess, not checkers, and we care about what happens to this industry over a long period. And you can't really look at what happens in one quarter. That's how Wall Street, certain people on Wall Street love to look at it. That's how CNBC looks at it, right? Because they're members of the media. They need those headlines. But if you think about Disney, Disney lost $420 million in Q3 from its D2C business. $420 million. Now, that's a lot better than the $1.1 billion they lost in one quarter a couple of quarters ago. But let's keep that into perspective. How did they get to that number? They got to that number by doing layoffs, over 7,000. By cutting out content costs. Now, part of that was because of the strike as well, but cutting out content costs. So that means less content for you and I, not as many hits. So they made some bad choices in terms of some of their franchises and what they produced. And they raised rates. So that isn't something that OTT platforms can do 2, 3, 4 times a year or every quarter to change the numbers. Fundamentally, they have to really change their business. Some of them, not all of them. Now, we already know Disney's going there. The interesting stat for me for Disney was ESPN Plus was profitable, generating $33 million. That's fascinating.
Yep.
So can they continue that? Can they keep that going forward? So what I look at are the data points that tell me where the market is going to go in the next 12 months, in the next 4 quarters. And you're right in that from Roku and a few others, we heard just a little positivity from them on the ad side, saying they felt it was getting a little bit better. But to your point, when you see the numbers improving, there isn't a single company that we could talk about today that hasn't done layoffs, at least one round, and or raised pricing. So the moment you do both, your balance sheet is going to change very quickly. But that by itself is not sustainable. So Q3 going into Q4, I think Q4 for some of the OTT providers is going to be fairly okay in terms of ARPU, in terms of sub numbers, in terms of loss, potentially positive EBITDA. But don't let that distract us from what's going to happen next year. It is still going to be a very rough year in 2024 because of the macroeconomic conditions taking place in the business world and just in the world in general is creating a lot of uncertainty.
So on one end, what you're saying is there are tactical moves that improve the number for a quarter. And clearly you cannot continue to fire people because at some point you need someone to operate your platforms. On the other end, I see a little silver lining. So when people raise prices, subscribers that didn't leave in masses.
Yeah, that's
is
right.
That fair to say?
From what we know,
news.
Yes, because Disney and some others came right out and said, now they didn't give us their churn numbers, they never do, but they came out and said they did not see I forget the exact word they used, but they didn't see an impact. So you're right. So far, we've not heard of any company, Netflix, Paramount, Warner Bros. Discovery, Disney, who says because they've raised pricing, it's negatively impact their churn and retention. But what's that threshold? You and I and everyone else are only going to pay so much for services, and we don't yet know as an industry what that threshold is.
Yeah, on one end, to be honest, I was a bit shocked. Again, I'm someone that was in the business, that I'm in the business, I'm observing the business, I'm also a consumer, maybe a special one in some ways. I always thought that whatever, $14.99 on these prices for one service. People complaining about that price, it's ridiculous. I mean, in some places in Italy, I go for breakfast and I spend that money.
Sure,
so,
but they don't compare it to food.
I know, no, and sorry, it's not that. But the problem becomes when, and again, I think I have so many subscription services that I'm trying to keep track because sometimes I don't know exactly what I have. It's also because I do it professionally. But when I put it together, it starts to become, maybe now I have to cut some grease somewhere because it's too much.
I don't disagree. I think one thing our industry forgets too is remember that many of these services always sold us on one value proposition: cheap. Think of live linear services. Your average live linear service now for a pay TV lineup comparable and streaming is $85 a month. Remember when they came out, what did they sell us on? This is cheap, cheap, cheap. Yeah, it's not like pay TV. It's different than pay TV. Yeah. That's nonsense. It is pay TV. It's expensive. Okay, you don't have some hardware fees. You maybe don't have some RSN costs and some taxes, but it looks exactly like, and it's bundled like, and it's not a la carte. So even Disney, right? Disney came out. I looked it up the other day. If you were in Disney's, I forget what it was called, but like you were a super Disney fan, you signed up for Disney Plus before it launched for a 3-year deal, you were paying $3 and something per month. Wow. So what was Disney thinking? That they were going to make money and charging users less than $4 a month? So it told us as consumers, hey, this stuff is real cheap. It's real cheap. It's good content. It's real cheap. And now all of a sudden they're like, oh, we actually have to make a business out of this. So I also don't think a lot of them were smart in how they came to the market, to your point, in terms of getting consumers to think one way. And then all of a sudden it's like, wait, this is now really expensive.
Yeah, absolutely. I think, and I see it in very cases when you focus on reach or the acquisition side, you start, because also you don't know, will they buy it? So you want to, the problem is the moment you have to really increase, and not in a minimal way, but substantially, that's another friction point. That's another churn point, if you want.
Yeah. I mean, and also just, look at Netflix. Netflix from day one has been called Netflix. It's been SVOD content. no sports, no news, no live linear,
Yeah.
no fast channels. Its app has never changed in terms of what it's called. Just look at Max, right? I mean, I love Max. I think they've done a great job. I think they've done a much better job with the new apps that they've built just for Roku and whatnot. But that was HBO, HBO Go, HBO. Then they had the HBO Now version. Then you had HBO Max. Now you're at a Max. Now you're rebundling. Now all of a sudden they have a sports package you can layer on top of that. That's all in like 4 years. So what do you think that does to consumers? Right? You and I, who are tracking this every day, have a much better understanding of what's going on. But the average consumer is overwhelmed. And while we all love choice as consumers, whether it comes to food, music, entertainment, whatever it is, choice also brings complexity. And I saw something last night, and I wanted to bring up in the podcast today. So I was watching Netflix. In the middle of a Netflix show, documentary, an error came up on the screen. And it said, sorry, we've recognized a problem with the Netflix application. Please click restart, and we'll put you right back into your show where you were. So right on the screen, it's super simple text. So I just clicked restart. The app on itself, this was on Fire TV, the app by itself just restarted. You saw the Netflix thing. It went directly to where I was, restarted the stream, boom. And it was all within 5 seconds.
Wow.
Now, on so many other services, it would have been error code 781254, right? Like, what am I supposed to do with that? So this initiated me to simply restart the app with one click. Like, the user experience of Netflix is above and beyond anybody else out there at scale with quality. And that is something that far too many people don't put enough value on, even in our industry.
To be honest, you're like kind of beating my drums, because I've been harassing in a positive way product teams, UX people, really, because I was always a consumer. So I would pay with my credit card, whatever service we would launch, just to be a normal consumer. No VIP access, no fake credit card. And very often, you really have to see it from a consumer point of view. And of course, frictionless is a buzzword, but it's true. I mean, I read, I don't know, was a tweet, whatever it was. I read something today saying basically, you want me to pay for your content? I don't remember the source. And you make it so difficult that even if I want to pay for the content and I'm happy to pay about it, you're starting to make me think that piracy is a good thing, because you're so making it complicated for me, willing to pay that. Oh, come on. So that's a message that the industry should really take and keep it in front, like this, in front of the laptop when they work, I think.
Yeah, look, ease of use is what sells. So you remember back in the early days, you had, I think, we had 10 or 12 different streaming devices in the market. Remember, we had Boxy, we had Vizio, had a device out there. D-Link had a box. Like, all these guys had boxes. Now, why did Roku sell so well? Right? People always like, oh, well, they were the first mover in the market. No, the reason Roku sold so well was because it was so easy to set up that my mom could do it. And it happened to have all the content apps that we wanted at the time. So, you know, our industry runs around wanting to argue about bit rates and codec and compression and all this stuff. And I keep saying, seems like forever, the best technology is not what's always adopted. Ease of use is super important in the market, to your point, as a consumer, because it has to work and it has to be easy. And some of these services are doing a much better job than they were a couple of years ago. But in order for them to also do that, it means they have to invest in the business. And it's hard to invest in the business when you're not generating positive free cash flow. You've laid off people, and the interest rates for money now is ridiculous. Right? So that is a huge problem, especially for vendors who are supporting a lot of these OTT platforms. Vendors going forward are going to have quite a few problems in terms of getting money. And if you don't have money, how do you invest in your business?
Now you're painting a kind of a very doomed market picture, but
no, I wouldn't say doomed. I'd say reality.
Okay, but exactly
not enough people in our industry are living in reality. They're living in fantasy, right? They just think like, oh, a company just goes out and get money. Go talk to companies right now trying to get money. You've got about a 13 to 15% coupon. Let's use the example. Just yesterday, Edgio announced they raised $66 million from a current investor, which is great for them. Now that current investor exchanged 95% of its existing unsecured 3.5% convertible notes, which were due in 2025. They exchanged those for 3.5, you ready, to 16% payment in kind.
Whoa.
So it could be as high as 16%, or it could be low as 3.5. 3 years ago, that number would have been 1.5%.
Yeah, absolutely. Yeah. I can see it on my mortgage. You don't have to convince me, even in Italy. So, but before you mention a bit, so I'm trying to create a storytelling because everybody is talking about let's say the OTT platform. So that I've always worked for a vendor basically, and I saw one of the few that really do it. The vendor ecosystem, the mechanic of how this OTT platform buy from these vendors. There's not a lot of conversation because I think a bit the competition and a bit creating this kind of intelligence there's no one that really has an interest, and in general the public doesn't have an interest. So in terms of OTT platform, what I see in my partial view is there is big tech becoming super important, big media consolidating, aggregating, as you said, Max, tum. Maybe we can talk about sport vertical because I'm in sport, but at the moment they're not super relevant. And then there is everybody else. A lot of the vendors in the ecosystem, but the category by category, I would say, mostly serve in certain categories, serve the owned and operated one. So if everything is consolidating, instead of having 20, 50, 100 clients potentially, you may have 10 to 15, 20, and it's great if you win the big one. It's bad if you lose the big one. So
yeah,
it's a complex question, but how do you see the OTT platform market, big tech, big media? Do you have another way of describing it? Why not? And what do you think is happening with vendors?
Well,
That's a very complex question.
Yeah, no, I think you framed it really well. Part of the problem we have in the industry is everybody wants to do comparisons, as if it's apples to apples when it's apples to bowling balls. Right? So you have vendors in the market that are very focused, very specialized. I'll just use encoding.com since I was a shareholder of them, and they did get acquired by Telestream. But encoding.com was really good at one thing, encoding. Right? And they grew their business nicely, and they were profitable. Now, they were small. They grew organically every year. But they didn't try and become a $200 million company, go out and raise tons of rounds in a market that's extremely crowded. So they got a nice multiple when they got sold, and they focused. And the vendors that focus in the market, I think, are the smart ones, because the vendors that over the last couple of years are trying to say we have an end-to-end ecosystem from glass to glass. The vast majority of them don't. They're managing a lot of partners in that ecosystem. You have a lot of customers that don't want end-to-end completely, but you also have an interesting thing that's taken place in the market over the last couple of years where, let's just use Disney as an example. Everybody wanted Disney as a customer. Right? Everybody wanted DSS as a customer, Disney streaming services.
Yeah.
How many companies are the size of Disney? Very few. Disney wants the lowest price in the market for everything. Yeah. They expect the best level of service for everything, right? For many vendors, Disney is not a good customer. You cannot make money off of them. And vendors realize that in many cases too late. So I like the vendors that are approaching the market where's there a segment in the market we can go after that others are kind of ignoring or just not. Yeah. For instance, on the CDN side, I recently profiled CDN 77 because they came out, even though they're private.
I saw that.
And they said, hey, you can put out our numbers, right? So it was great that they let me put out their numbers, but they're not going after Disney. They're not going after Warner Brothers. They're not going after Comcast. They're going after the mid-tier market that's spending $50,000 a year and more, not $50 million and more. Very smart, because they're also profitable. So vendors have to look at what they're really good at in the market and what problem they're solving. And these vendors that are trying to sell technology continue to lose. This is not a technology sale. This is solving a problem sale. And you also have to understand the vertical market you're selling to, because far too many vendors during COVID simply said, okay, I'm going to repackage what I do in the media entertainment space, and I'm now going to call it an enterprise offering. No, enterprise requires a different solution. So you also have that issue. The other issue, I'm going to come right out and say it, is you've got some ridiculous egos at management teams and boards, because some of these numbers that they're putting out in terms of the size of the market or what the compound annual growth rate will be or the TAMs, they're not even in the ballpark. We have the data to see that. And then finally, I'll just say, I had it up on my blog maybe about a year ago. I looked across all the vendors in the market. I counted more than 100 executives that have been replaced in an 18-month period at a CEO, CTO, CFO, or CRO level. 100. And that's just what I could count. So interesting how many boards right after COVID brought in new executives to run video companies who had no understanding of video, but because they sold a SaaS-based accounting platform on the web, they brought them in because they're like, you'll transform our business into a SaaS platform.
Yeah.
And yet they don't know anything about our industry or the problem that's trying to be solved. And look at how many of those executives in those 18 months were then replaced again. So that's a bigger problem. And the finance side, in terms of what we're seeing with the money, I said on my own podcast, earlier in the week, look at how many vendors have between $15 and $30 million in cash and cash equivalents. A lot. And with that money, you can't do acquisitions, nothing transformative, and you can't invest in your business too much because you need that cash. That's going to continue in the new year.
Yeah, and I have a question on SaaS. Do you think what do you think is the role of SaaS in this industry for what it makes sense going forward? Because on one end, the company that create a solution for you, maybe it's a portion. I would see, I think, but again, not easy, a balance of SaaS platform and specific build for, with clearly the big guys wanted more and more control of what they're doing. And even like the sport verticals, which are clearly very small, start to, in this phase, because I think it's waves, to have control and use smart providers and platforms to put things together. But I don't know. I mean, what is your point of view there?
Yeah, I would agree with that from a high level, but I think we have to remember as an industry, it changes. So think of, Turner, iStream Planet, right?
Yep.
Warner Bros. Discovery, right? All of a sudden, these guys had in-house platforms, and then what did they do? Well, they shut iStream Planet down after a couple of years, and they started using other third parties. So we saw this consolidation of BAMTech, iStream Planet. I'm going to forget some of the others already, that were acquired and then bundled, and then now you had it in-house, but then years later, companies were like, well, maybe we don't need to use our platform for everything. Maybe we do want to run this outside of our infrastructure, so to speak. So I think that's a little bit of a wave that comes and goes in our industry, depending on what OTT platforms are trying to do. Now, when it comes to live, obviously that's a lot more complex. You do need to go outhouse with a live video stack. You just, how many people are the size of YouTube? Very few. So it makes sense for live. Also for live, as you've got specialists in the space that really specialize just in one particular thing. Netflix doing their live event this week for the golf tournament, right? They used a lot of vendors in the market, and it makes sense. Netflix doesn't own their own truck and rolling up and, with their own transponder time. So there's a portion of that workflow that is always going to be outsourced to vendors. Live is a whole different animal. But there's no one size fits all. And I think, Carlo, that's the biggest thing that frustrates me in this industry, especially on LinkedIn, is people making comments like, this is better than that. Well, what size customer are you? What are you trying to accomplish? No one ever asks those questions unless you're in the sales process of a vendor.
Yeah.
And even then, sometimes they don't do a great job. So this is about solving problems, and companies look very different. They're geographically dispersed differently. They're offering services in different markets: SVOD, AVOD, pre-roll, post-roll, in-stream, in-page, pay-per-view, pay to download, pay to rent, live, on demand, sports or no sports, live linear. There's a lot of options. The business model changes. Yeah.
No, I'm surprised that even talking to people in companies that are, say, more on the video streaming side, they don't, and this is it was a reflection after IBC. I was talking about, I'm focusing on the monetization aspect, subscription, etc. They said, we have something, we're doing it with Stripe. I mean, okay. I mean, it means they don't really appreciate. So I think there is few people in the industry understand the full frame. So every, like what you mentioned is already even a long list. It's not even everything, right?
Right.
So
right.
it's complex. It's complex, but I think there is a responsibility to have the industry more understanding really all the angles, because then you launch something and you obviously are in a certain phase, but then you need to start monetizing. You need to grow your subscriber base. But so it's super complex. I've been lucky enough to be inside some of these services also from a joint venture point of view, so I could access everything. And it was a masterclass. I mean, having a paying customer in front of you changed completely the perspective. Creating hybrid, very complex funnel that goes from AVOD to SVOD to whatever. These are complex stuff, and I think the industry has to grow up a bit to become sustainable. And maybe it's not even enough, but let's see.
Well, it's interesting you say grow up, because this year marks the third decade, 3 decades, right? 30 years. Most people don't even know that. Part of the issue too, Carlo, I would say is, I take calls all day long, free, right? My number's posted everywhere. Call me anytime. I take calls every single day from people, executives, board members, Wall Street, but a lot from people in the industry looking for a job or wanting to move up in the industry or change jobs. And it's incredible. I think many in our industry might forget how many new people come into our industry every year. You've got people in our industry that are only here 2 years, 3 years. They know no history. They don't know where the technology started, where it went. And a problem with that is they can't look at previous lessons we've learned and apply that to what they're doing now. The amount of companies I hear from who reach out to me and say, hey, I've got this new P2P distribution technology, which is going to reduce CDN costs by 10%. The first thing I say is, well, that's not a problem in the market. Why are you solving it? Well, what do you mean that's not a problem? Right? They don't even know the history or compression. The amount of people who call me who claim to have some sort of compression thing, like if you go talk to the CTO of any of these OTT providers, video compression is not on the top 10 list of anything they're trying to accomplish. It's not a problem today. So I also think because we have so many new people in the industry, and in many cases that's at a C level, that's at a board level. I am invited to board meetings by companies. So I will go into a board meeting to companies, we all know, mostly vendors, but not always, and just talk about, they want an outside perspective of here's what's really going on in the market. I'm always amazed at the questions the board members ask because of how basic they are and how I'm shocked they don't already know the answer to that question. Like, what are you reading every day? Nothing. Clearly, right? They don't even know from a high level that Netflix is projecting $6.5 billion of free cash flow this year. They have no idea. And yet you're a board member of a company competing with them. So to me, that's just shocking, because the number one, value in the market, I always say those that have the information are not the gatekeepers. It's the ones that control the flow of the information. So how are these people not educating themselves if they're actually in that space? So I think that's just a huge problem we have as well. It's just the lack of education of what's really going on versus what people think is going on.
But, so on what you said, the one story that gets me a bit is latency. Not saying that latency is irrelevant, but how many conferences you have been that latency was number one problem? In some cases, it can really be. In some other cases, nobody cares. And I normally, nobody agrees with me, to be honest. So I still have it as a point where, really? Yeah, latency is great. And everything would be nice with zero latency, but it would cost. And
but think of who's pushing latency in the market. Vendors. And why are vendors pushing latency? Because they've raised money based on this idea that we're going to solve a problem of low or ultra low latency. And they have to tell the board and the investors, this is how big a problem it is. But then when the NBA comes out and re-releases their new app and says, we don't think latency has to be under 10 seconds. We don't see a value. It doesn't impact our business. What do they need to do? They need to counter that with even more information of like, no. They're doing it wrong. They should have used us. They need ultra low latency. And the other thing is, the only time you hear about ultra low latency is with betting.
Clearly.
We're not doing in-stream betting. It's not taking place right now. So people are saying, well, it will come down the line. Okay, it may come down the line, but you're trying to solve for a problem that doesn't exist today. And that's an issue.
That's a good point. It's not something that I thought about a lot, but I agree. And obviously, again, I'm on the vendor side. Vendors are good, so.
Yeah, well, but you talk to but you also talk to customers, right? And
I know,
so
a lot.
right.
A lot.
So talk to the CTO of a Paramount, right? Or some of these companies, and I do all the time. And when I ask them, hey, where's ultra low latency in your list of 20 things you want to accomplish? And for the most of them, it's not on the list at all. And when I ask why, they say, real simple. We could go and we could invest, pick a number, $5 million to roll out lower latency for our streams. Does that give us more signups? No. Does that reduce our churn? Exactly. No. Increase our retention? No. Does that make our workflow more complex? Yes. Now, I could take that $5 million and I can put it into personalization. So you get better content when you're searching for content, which keeps you on the platform longer. Where am I going to invest my money?
Absolutely.
So there has to be a business case behind it. And far too many vendors in the market just want to push technology, not solving a problem.
Yeah. And the other part that I wanted to comment is new people in the industry. So there's one area in which I've always welcomed new people in the industry is the direct-to-consumer marketing side. So I saw people coming from like Tesco in the UK really bringing value, because our industry has mostly been, and the companies are mostly full of B2B people. Nothing wrong with it.
True.
Because a lot of the media. So when I was telling to, my previous company, I was saying, okay, look, direct-to-consumer marketing is complex. Nobody understands it. I was saying, no, the media people, they know it. Very often they did. Even them, few cases you have teams that really understood the direct-to-consumer marketing to clearly, the funnel, acquisition, retention. And I think in that case, maybe why not? Otherwise, I agree, it's super dangerous to bring people coming from different industries that don't take the time to learn, because, experience is one thing, learning is also another option, right? To be honest.
True. And, you bring up an interesting point, because many years ago, and I give Netflix credit for this, is they hired so many consumer behavioral specialists more than a couple years ago. And not just a data analyst, right? Not just someone analyzing data, but data scientists. And it wasn't around codecs and compression, right? They had all that. It was, how do people actually want to interact with their content? How do they search? How do they navigate? They are, again, the best in the industry at that. And they learned a lot of lessons early on. And one of the lessons learned early on was what was going on, to your point, with consumers in the market. So when Starbucks first rolled out the ability to tip right there at the terminal, and I forget what platform it was, there was like 4 or 5 options to leave a tip. And Starbucks data scientists and engineers and the consumer people over there realized that tips weren't being left because people were overwhelmed. Mm-hmm. The moment they changed this, and this was many years ago, 6-7 years ago at least, the moment they changed it to 3 options, what happened? The vast majority of people picked the one in the middle, because they didn't want to tip too low. They didn't want to tip too high. So the consumer behavioral specialists knew how to funnel people to exactly where they wanted them to tip. And it's things like that Netflix and other companies, maybe as long as 10 years ago, started noticing, to your point about consumer behavior. Yeah. And far too many companies in our space are really only looking at that right now. And they're looking at it and saying, well, we're providing this personalization for users. There's almost no personalization in our industry whatsoever. I'm going to just say that's absolute garbage. I keep getting recommended stuff for children's cartoons. I don't have any kids. Like, there's all this kind of stuff where personalization just does not exist. Now, I'll give you one more example. I ran some numbers on this. So Amazon, they come out with Prime Video has one of their own series. It's let's say Jack Ryan, right? It's 10 episodes long. Now, after I watch the first episode, when I go to the second episode and I start skipping the intro, and then I go to the third episode and I skip the intro, why doesn't Amazon automatically skip the intro for all the rest of them? Because if you think about it, that's a good point. If 100 million people are watching that and half of them you automatically skip it, do you know how much bandwidth savings alone you're talking? It's ridiculous. Why isn't AI doing that, or machine learning, or all the stuff people are talking about? So to me, that's the level of personalization we should have.
On the other end, when I first saw skip intro, I said, "Oh, I want to kiss the guy or the person that invented that." because skip intro. The problem is now for me is like we're watching at dinner. It's ridiculous. We're watching Friends in rotation with the kids.
Okay, and that is ridiculous, but that's a separate.
Yeah, okay. Skip intro means where is the remote command? Press the button. So absolutely, that's the real one. But you mentioned AI, and so just to wrap it up, NAB in April, you will have the summit again, the streaming summit. A lot of ambition, a lot of people, a lot of panels. I follow online. The last one was very good, but you're adding an AI track to it. Can you talk a bit about I think it's. I don't want to say it's obvious, but I think you're very specific. What I like is what you've read in your, in your website, and the fact that you're opening now for speakers. It's very specific, so which is good. Otherwise, it's whatever.
Yeah. So I've always been one where I feel like my responsibility to the industry, again, is not to sugarcoat anything and to be realistic. If we don't set realistic expectations in this market, it impacts vendors, it impacts investors, it impacts you and me with our jobs. A good example is when Elemental Technologies got acquired. TechCrunch put out an article saying they got acquired for $500 million. And as a result of that, all these other vendors in the market were like, oh, if that's what they're worth, this is what we're worth. Well, it turns out they were acquired for $296 million. And we know that because of a regulatory filing. And yet TechCrunch never changed the article. So to this day, I still have people who come into the space thinking this vendor was worth $500 million. Without the proper information, without the reality of these applications of what's taking place, we're setting ourselves up for failure. So I felt it was time to bring AI into the discussion at my show. It's not going to be around some of the previous topics that other shows have covered, blockchain enabled encoding at the edge. This is nonsense. So with AI, to your point, I'm being very specific. What I want to see is I want to see AI applications. Sorry, I should say I want to see AI technology that's being applied to an application. So I want to see some demos of this working. Not this is an idea that it sounds good on paper. No, I want to see the actual customer, how they're using it, what they're using it for, what the benefit is. I've already got some really good proposals from Paramount, some OTT platforms, as well as some vendors of like, we've actually rolled this out.
Good.
Here's how we use it. This is what we're going to discuss. So the show, again, next April, it will be expanded, still in the West Hall, but we're moving the rooms down to the first floor, which is great. I think realistically, we'll probably double the size from last year as far as attendees go. Yeah. So my focus going forward, I'm not going to do a New York show anymore in New York. The NAB, it's too complicated in Manhattan now, and at the Javits, and just it's expensive. Nobody wants to go to the West Side. So focus on Vegas, grow that show over time organically, continue to grow it. But I'll have a full track on day one of just AI related topics and demos and case studies.
Okay, that's cool. So thank you. We can stay for the full afternoon, but I think nobody wants to listen to us for such a long time more. Hopefully, maybe it would be good to do it at the end of the next quarter if you still have time.
Sure,
and see what has changed in 3 months. But so thank you, Dan. Really like talking to you, and I think we had the time to explore a bit more than in the normal 3 minutes interview.
Yeah, which is I appreciate it, because CNBC, like, it's great, but it's like you have this time and you're done. So I appreciate actually being able to talk a little more casual. Look, you're a guy with a scarf. I'm like, for today, I'm a guy with a hat, right? So, but appreciate the time today, Carlo.
Okay, thank you, Dan. See you soon, and see you in Vegas, obviously. Okay, thank you. Ciao.
Take care. Bye.